Okay, welcome everybody. Subio, nice to see you. Nice to see everybody. Kim went through this already, so I won't spend too much time doing that. I had a couple things I wanted to talk about and show some letters that I got. A lot of nice emails. Listen, whoever sent me homework at 5:45, not going to get checked right before class. Come on, man. The cutoff for homework needs to be 4 p.m. Eastern time. All right, so I at least have an hour or so to look at it. The guys that got it overnight, thank you. I spent all night looking at it, going through my emails, and keep an eye on the charts. Some great setups last night. I'm going to point out a couple of letters that were really cool. I cut out the email address on this one. This gentleman was following Euro CHF, which was fantastic. It had a couple 3 days down. Very nice spike to the low at the end of the U.S. session. It came back and hit it again right at the London Open. I got some snapshots of it. We'll look at it. But he figured they would push it to the ADR. They did. Looking at the Mayo, I took it there for 252 pips. I see how smaller traders had their buy orders just above the quarter wood, which is a consolidation or accumulation zone in the market. They wanted to trigger them orders long, and I said I bet they will reverse better than 30 pips to take a lot of them before the continuation. Look, I don't know if you can see that on my screen. Homework's still coming in. Shame on you guys. All right. Anyway, this was a nice trade, 252 pips. Great job. You know who this is. This is from Dave McCoy. He's the real McCoy. I joked around. He's turned the corner. He's been around me a little while. Met him in Orlando, a fantastic guy, an eye doctor, but I'm still blind. He didn't help my vision. I don't know what's going on over there. He took EU short. Reversal got his 50 pips. EJ got 50 pips. GJ got 65 pips on the same setup as EJ. Fantastic night, Dave. Proud of you, buddy. Glad to see this. And this is from Murray, I think. I finally turned in the corner, not falling for the stupid circular and counter trend trades. I wanted you to see that and perhaps comment tonight on 2 trades I posted in the forum earlier. Haven't had a chance, buddy. I'll look at it later. I increased my demo account 25% in 2 trades with about 2% risk per trade, no fear. Would have put 10 standards on them. That's how certain he was of the setups. Fantastic stuff. Great to hear it. Some of the markups, Lisa Stewart, if you're here, this is an excellent markup. Proud of you. Great job. This is what your markup should look like. A lot of you, it did not. No problem. This is what it's supposed to look like. Okay, here's another one. The name fell off, and I'm sorry. I don't know who I dragged this email out of, and there were so many emails I couldn't go back. If this is yours, great job. Fess up. Let me know. You should be proud of it. I'm sorry. I won't make that mistake again. I dragged it to my desktop, closed the email, and couldn't remember where the hell it came from. Sorry about that. But this is an excellent markup also. Okay? Some of the people asked me the trade that I was eating at, having dinner at the Columbia, and missed it, the one that Rick grabbed. Yeah, can you guys see this? It says some people say they can't see my screen. I didn't ask if everyone can hear and see. Should not be a blue screen. Okay, good, good. John, reboot, refresh, download Java. That's the 3 solutions. Look, come in and out, reboot your computer, and make sure you have the most recent version of Java. Okay, thanks, Asubio. Good stuff. All right, look, they set the low here. This is GJ, pound yen. The trade was better actually in EJ, but they both set up identical. Okay? They have the low formed, they pull away the whole session, and they come back and nail it again. Okay, what I want you to see is variations on the theme. They hit the same thing 3 times, right to the 4-hour mark. An easy grab out in 3 bars. Okay, this is EJ, Euro Yen, which is the same setup, but I want you to see how the second leg, let me grab my marker, sorry about that. The second leg came in here. See the blue tracer right there where I drew the yellow line? The second leg came right down to the previous level, opened the spread, pick up the orders, and got the hell out of there quick. Your entry is right here, and in 3 or 4 bars, you're up big. There's absolutely no pain or no drawdown in that trade. Right? I know I told you that in the thing, and you called bullshit on me, told me I'm crazy. I promise you, in 30 minutes, you were up big, and there was no pain on that trade. You'll start to recognize these things. The market maker does the same crap over and over. That's all he's got. He can hit your stops up or down, change the direction that he moves off of one of these formations once he catches the retail traders going the wrong way. Once you understand this, the game is 90% over in your favor. Okay? Understand it's just variations on a theme. He'll make deeper stop hunts or deeper vector candles to try to trick you, to make you perceive momentum. All right, this is hilarious to me. I don't trade the Turkish lira / Japanese yen, but people say, can you trade this in every pair, anytime, any place? The answer is yes. Look at this pair right here. It's the Japanese yen, Turkish lira. When's the last time you ever looked at that pair? I know, me either, except today. There's your vector, 3 to the high, 4-hour resistance. They pull down, consolidate. There's shift the zone. There's your entry. There's your U.S. reversal, W formation, back to the watermark. Hilarious. To me, anyway. It's in there. Turkish lira, Japanese yen. This is a repeat of what happened last night. Here's your consolidation zone. This happened in euro. This was a few weeks ago. There's your stop hunt low. There's your vector, 3 to the low. 3 swipes at the low in the shadow box. There's your entry. No pain on the trade, except the spread. The spread's brutal on that pair. Straight green candles rise right past the mayonnaise. And notice in here how they come back, test the mayonnaise, and continue on. They test those points because people trade the average or moving average crossovers. So those points have to be tested. If you know better, know where you are in the cycle, you won't fall for it. I think Tony T sent me a slide where he tried to short something similar to this. Tony, you got to know where you are in the cycle. You tried to short level 1 consolidation after the peak. All right, I know it's a mistake a lot of you make. You need to understand the shadow boxes, the timings, where you are in the cycle to not fall for those type of things. Okay, I showed you Turkish lira. Here's last night. Okay, Euro CHF. This is the one I was looking for. Euro CHF, look. It's been dropping tremendously. I think it fell over 800 pips. Stop hunt right out of the box. There's your consolidation. There's your railroad tracks to the low. At the appropriate time, that trade was painless. You were out in about 40 minutes or less. 35 minutes. It was over. Second bar, not 1 ounce of drawdown. The spread was a drawdown. In profit immediately. Stop loss goes below the low. That's a beautiful trade. Coming off, this is, look, pay attention. Let me toggle this so it goes away. A big, fat W right in your face. There's the entrance. The entry, right? See it? GBP CHF, Euro CHF, all the same. Okay, this is Euro CHF. The only difference, the spike came at the changeover. See it? The spike came 5:15, 5:30. They held it. It was a little bit later. It was a little bit behind the other pair. No big deal. But don't you see what's in here? You have your drop. 1, 2, 3 intraday. 3 levels of drop. Spike the low aggressively. Repeat the level at the London Open. They come back. They fail to take out the low. Look very closely right here. Right there. Let me draw a big fat arrow for you. See the blue tracer in there, light blue tracer? When they pin the light blue tracer, that is evidence that they are picking up the orders on the other side of yesterday's low. But they do this by opening the spread and not releasing other traders. They're stuck -5, -2. Have you ever been in a trade where you get really close to getting out, -5, -7, you think you're out, and all of a sudden they shift it away from you? Right? Has that happened to you before? Of course it has. They know this. They come into the same levels, spike it, open the spread, pick up the orders, and they get the hell out of there. Look how quick this trade went into profit, and they got out of there. This was a 200 pip rise straight before you had the first level of consolidation stutter. Notice where it stutters. At the 200. Why? Because traders probably tried to play the bounce short on the 200 EMA, which is crap. The signals, the pins to the mayonnaise and the shark fins and all the stuff I'm going to cover are meaningless unless you understand where you are in the cycle and know. If they pin to the mayonnaise as a stop hunt, that's a setup. If they pin to the mayonnaise after the stop hunt in the middle of the run, it's a different story. Stuff I'm going to talk about, variations on the theme, understanding where you are in the cycle. Okay? A lot of you wrote this to me. Someone said in the letter I wasn't supposed to trade, but I did. Sorry, but I couldn't help myself. I saw this and I about fell out of my chair. I love emails like that, but even though you should just be observing, not trading, that's fine. But it was kind of easy last night. Every major did this setup after the drop, after the correction. Why? They let out their money. They let out their money. They let out their money. Man, we're running low. Let's correct against the trend. Let's rise price against the downtrend to get our money back. Understand, start thinking like a market maker and stop thinking like a retail trader following the technicals that everybody else sees on the chart. When you see something so obvious that it's a downtrend, you need to start thinking, apply the brakes and look for the reversal. This can be hidden behind news, can be hidden behind any geopolitical event, any garbage, the debt ceiling, they blame it on anything. Anything that's out there, they'll blame it on. That is on purpose. They create an attitude or a sentiment about the market. The Eurozone's crap. Euro's going to correct. Euro's going to correct. Out of nowhere, Euro rises. Understand this is on purpose, and it's to get you to chase the wrong directional move. All right? No, I don't want to offend the guy. I've took the email out. This was the worst email I got. Didn't I spend 20 minutes talking about this clock being a piece of crap? No offense to the guy that sent it. I'm not mad at you. I'm just mad that you didn't pay attention enough for me to tell you that these session times are shit. I told you the times I gave you on the slide are solid gold. Everything else that's out there is propaganda to keep you trading incorrectly. This slide comes from people's inability to understand the session changeovers. If you sent it, I'm not yelling at you. All right? Do not use this clock. Use the times I gave you. There's a script in the forum to ping your broker server and get the GMT offsets for the server. I think Gary put it in there. That's what I want you to use, all right? And if I misunderstood why you sent this to me, I'm sorry, but this like broke my heart. I spent an hour talking about time ribbon matching up, going over the times, everything else is crap, and then I opened the email and saw this clock. I fell out of my chair for once. All right? Okay, let's see. All right, let's get these photos out of here, and I'll get into the slides. We'll get caught up where we were. Taking me a second. All right. Some of your markups were not as good as this, and I'm not picking on anybody. I just want you to get it right. It's important. We're going to do some training on how to do the homework, but this is the kind of markup stuff that we're looking for. Get the times, the shift bars. Today I'll make a list of the things that we talk about that you should be looking for. Okay? All right, let me get caught up. You guys are not taking a break that fast. All right. We're going to talk about the trading zone and how it's set. All right? I'll take questions at the end of the class. Just relax. Open your mind. Enjoy yourself. I see a lot of stuff flying by. We'll talk about the setups. Let's talk about the trading zone, how things are set up. Don't worry about the charts right now. Just try to open your mind to the concepts. It's coming. Relax. We'll get there. Okay? All right, the trading zone. I want you to learn how to identify the key points on the chart where you can safely enter into trades. That is going to answer your question about the M's and the W formations. Relax. The highest probability setups that will allow you to become most profitable. I didn't say profitable. I said most profitable. I want you to nail this. 8 out of 9. 8 out of 10. That's the kind of success rate I want you to have, hit rate. Okay, so let's go over it. The ideal Asian range is 50 pips or less, right? Tokyo channel, for you guys to know what that is. All right, some people are saying they cannot see that. Barbara, can you? There's a slide up there. If you're having technical problems, my slides are up. I know my mic's working. If you're having technical problems, you need to log out, log back in. Make sure you have the latest version of Java. All right? Okay, Ben, good. Thank you, Adam. Thank you. All right. Ideal Asian range, less than 50 pips. If it's bigger than 50 pips, I'll show you how to handle that. The trading zone is set 25 to 50 pips higher or lower than the Asian range. Okay, Jose will talk about it. The Asian range sometimes gets blown out 100, 125 pips. You must then reconsolidate the last quarter to 1/3 of the box and understand the next possible advance or move. How do we do that? Okay. If the Asian range spikes down, the next likely move, if you have a 100, 150 pip news release, the next likely move is at the London Open second leg formation rise. If price spikes up 100 pips plus, depending on the ADR of the pair, the next likely move is stop hunt high drop. Okay? The new guys, I want you to practice in a good Asian range. So what I'm telling you is if you come to your terminal and the Asian range is blown out and you can't see where to reconsolidate it, that's a pass on that currency. Okay? Don't trade that pair if the Asian channel, Tokyo channel is blown out. The setup can occur in the last quarter to just outside the blue box. If the move comes a little bit earlier, and it does, and it will, you are smarter than a blue box. Understand what happened. The move came earlier, the high was formed, they made the second leg repeat the level, but didn't break it. Understand this, it is still tradable. Okay, am I going too fast? Am I pacing just right? I'm jacked up today. Okay, thank you. Okay, this is what your zone looks like. Now, you know we've put the gray boxes in here, but the problem is I want you to learn without the gray boxes. I want you to understand what you're looking at. I don't want you to look at a box and go, yeah, if it hits the box, I take it. That's not what we're doing here. I want you to conceptualize what these guys do and completely understand and immerse yourself in their behaviors, and you'll be able to walk up to a chart at any point in time and take a trade. Okay, so now, the setup occurs in the last 1/3 to 1/4 of this box. Okay, so remember the little story? They set the high and low at 5 p.m. They trade in between the range. They get right before the London session. They open the swing, and then they will make the aggressive move 25 to 50 pips in 3 swipes to form out the stop hunt. They will then pull back and go into contract accumulation mode. Right? Validating all the stuff you read in the textbooks to make you continue short. They will then make the second pass. The second pass can take out the first pass as long as it closes on a pin. If it does not close on a pin, it must railroad track. It must go down, do some damage, and come right back up. Close on a pin is a spike or a hammer bar that looks like that. I'll show you pictures of the bars. Just write down the notes. Close on a pin. Okay, here's what I'm talking about. Let me toggle these and give you a clean slate. Okay, here we go. Market maker set the high and low, trade in between the range, don't allow traders to get out. The last 1/3 to 1/4 of the box, they will widen the swing to pick up the pendings and snag the breakout traders and mess up their week. They will then make 3 moves to the low. And I'm going to cover that in detail today. 1, 2, 3 to the low. They will then pull back quickly and accumulate. This move out of the box, measured from The bottom of the range or the top of the range must be 25 to 50 pips. If there was a textbook, this is the example that would be in the textbook. Are they going to hit it exactly? No. We know that the pound crosses do 50 pip stop hunts on average. We know Australian and Canadian does 20 to 25 pips on average, as high as 30. If you guys don't bite, they'll run it to 50. I'm going to cover this, but I want you to understand it and hear it. Okay? Think about every textbook you ever read. Where do you put your stop? 7 to 10 pips below the entry bar. 25 pips below the entry. 30 pips. 50 max. You think that they haven't read that book or heard this crap? They know exactly where the stops are and located by the retail traders. That's why they knock them out. So simple. Okay? Coke, I think it's kind of funny that you're telling me to drink Coke when your name's Coke. I think it's great. Okay, look. So now, they spike the low in 3 swipes. Right out of the box. The distance is measured from the bottom of the box to this level right here. Okay? That's how we measure. If you reconsolidate outside the box, then you must measure from your swing low, to coin a term from my friend Craig, you must reissue the box yourself. Just draw the lines from one swing low to the other swing high. That becomes your range. All right, I'll draw that example in a minute. Market makers will consolidate off of the low. The last leg of the swipe to the low may look like an outside bar. Okay? Now, how do you know it's an outside bar? Because they're consolidating off of the low of the day to trap the traders that are already down there and to validate the textbook technicals to go the wrong way. Okay? That's what's going on. Now, the second pass comes in last night. It was ideal because it went right to the same level. And the pin, whoever asked me about the pin, was thrown down there to pick up the orders. Okay? Understand? Immediately, they came out of the zone. That's the formation of your W. You have a lot of things going on here to confirm the trade. As soon as they do the work and trap the traders, they want to create fear, greed, and panic in the market. That's their job. Their job is to keep you stunned and scared. And for 80% of the traders, I'm guessing, I don't know the number, it works. A lot of people say, man, I'm scared of this when I take an order. I'm not sure if it's right. I'm nervous the whole time. I look at my screen every 5 minutes. You are going to learn that when you get this thing right, it's over quick, and you can get on with your day and your life. You'll grab 50 pips in the blink of an eye, 45 minutes to an hour. No more nursing a trade and sitting there all night going, I don't understand why it didn't pay. Anybody remember the scratch-out limit? You take an auto stop yourself, or you take a self-stop? Anybody? Tell me the number. Thank you. 2 hours. Auto scratch-out, 2 hours. If you are not in substantial profit in 2 hours, scratch out. Why? They're holding the consolidation level to get more contracts. The straddle they were hoping for was not achieved. Okay, let's take that a step further. Gap time's over at the end of the box right here, right? The guy comes in. He tells him, hey, what's up, man? You know what? I got a boatload of traders trapped down there, about 500 million, 50 pips off of the low, Tokyo channel. So what do you want me to do? Go down there and get it. I think we can pick up 500 million on the stop, and it only costs us 100 million to get down there. Okay. That's the target, right? So now, guy comes on, London Open, pick up the breakout traders, widen the swing, get pennies on both sides, drag the market down to 50 pips below the bottom of the channel, hit all the stop-out orders of the long holders, induce people to take the short, drag the breakout traders that lifted their stop against them, snag them in position. Now, I'm down there. I'm expecting to accumulate 500 million at 50 pips below the Asian channel. My numbers didn't work out, man. Something happened. The traders didn't fall for it. I'm only about 250 million right now. My boss is going to be pissed. What's my next move? We know that the stops are triggered in 25 to 50 pip increments. I didn't achieve my target. There goes my freaking bonus this week. What do I got to do? I got to convince you that the direction is short. How do I do that? I hit it again, 25 to 50 pips lower. I'll consolidate for up to 2 hours. If I don't get the numbers that I was assigned or told I need, I can't just come up empty-handed. There's too much money involved for me to come up empty-handed. They're not in the business of coming up empty-handed. So what do? They attack the next level and cut this level 25 to 50 pips lower. Why 25 to 50 pips? Because it'll convince you, number one, that that's the direction. And number two, it'll hit the stop losses of the people that got it right, that were long. Then the same exact behavior will be seen. Usually, if they go over 2 hours and don't move, it becomes a 50-50 proposition. We are not in the 50-50 business. We are in the 8 out of 10, 9 out of 10 business. So what I'm telling you is that if you take a trade and it does not move into profit immediately like last night's setups, your job is to closely monitor the trade for the 2-hour stop clock. Put a timer on, set an alarm clock, whatever you need to do. And if you're -7, +5, scratch yourself out. Because the criteria or the setup has broken down, and I don't want you hanging around for a 50-50 shot. There's going to be times when you say, "Oh, Steve, it went my way." And I'm going to say, yeah, they did, but they could have just as easily went the other way. When they hold this level for more than 2 hours, something else is going on. They don't have the straddle that they needed. They don't have the contract accumulation straddle the way they needed it for it to be profitable for them. So now they got to extend the consolidation. With an extended consolidation usually comes one more swipe at the stops. It could be mild, which would be the third hit down. Right? You get that a lot. You get 3 hits to the low. If it hits the third time down, you're good. The trade's even more solid. It's going to reverse. Here's why. They didn't go down there because they were bored. They went down there for the cash. They grabbed it, got what they needed, and they get out of the zone. After the third hit, you can expect a major move. Okay, write that down. It's not on the slide. If they hit it 3 times, expect a major move. The better trade is if they hit it 3 times and each subsequent swipe is not taken out. Okay, does that make sense? Here's why. Let me just draw on here. They spike it, pull back. They hit it, come near it, miss it. They go on, hit it again, miss it. If this is rising, damn, I lost the slide. If this is rising, okay, that means that lower level shorts are grabbed. Don't let them out. Lower level shorts are grabbed. Don't let them out. Lower level shorts are grabbed. Got everything we need. Lights out. That's what it means. Okay? Now, back to the trading zone. Sorry the slide got wiped out, but I'm going to wipe this out now. Okay. Right, blah, 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 all this stuff. Okay, last quarter to 1/3 of the box. 1, 2, 3 to the low. 1, 2, 3 swipes at the low. It could be in 3 candles. It could be in 1 candle. It could be a railroad track. But when you watch that candle form, it's in 3 pulses. And I'm going to break it down for you how it pulses. Okay? So now, they pull back, they go into accumulation. Got to get my money, that's why I'm here today. They hang around. They push down and do not take out the previous level. That forms the W formation. Your entry is on a close. Confirmed. I'll talk about the variations on the theme in the candle. Your entry is here. The first target is the high of the day. Okay. Think about this for a minute. If the Asian channel is 45 pips, that's 50 pips right there, right? 45. If the stop hunt is 25 to 50 pips, let's just call it 75 pips. I want you to learn how to become a master at grabbing 50 pips in your sleep. Okay? And it can happen. And then the goal is to maximize your time in front of the screen to where you add contracts and you come out with the number of dollars you're looking for. Okay? So now, the trading zone, they come out in 3 swipes. They always pull off. They make some outside structure. Some structure that's lower than the current consolidation. Thank you, Paul. I've been working on my artwork. Okay? They will consolidate off of the low, away from the pin, away from it, because they have some number of people trapped down here. They do not want to release them. It's not their job to release money. Their job is to trap the money and punish the traders. Okay? So that's how this comes in. That's why it's an outside bar, an outside structure. Spike to the high, spike to the low, same thing. All right? Let's look at it again from this angle. All right? Accumulate all night, collect, collect, collect. All right, widen the swing, got you. 1, 2, 3 to the high. 1, 2, 3 to the high. Pull back quickly. Get off of that high. Trap the traders. Accumulate more contracts, validate the fibs, validate all the extension patterns. Anybody that got it right going short, we got to take you out and scratch you out of that. Sorry about your luck. 25 to 50 pips out of the last quarter, 1/3 of the blue box. Okay? That's how the trading zone is set. The entire business is how they handle the initial high and low, and the high and low of the day is the entire business. That's it. That's the whole business in a nutshell. Thanks, Dave. The fast move in Forex is fake because they're saving their money. They're doing it on light volume. They're flashing the pairs. So when it spikes out really quick, what you thought once before was momentum is actually the first leg of the stop hunt. The aggressive moves in this zone is to keep you confused about what direction, and the ones that got it right to stop them and shake them out and take their money. That's the nature of the beast. That's what they do. Okay? Your job is to take trades near the low of the day and the high of the day. That's it. That's your job. So with that job in mind, okay, here's a box that's blown out. Okay, coming out of the London session, there's the spike to the low. Bam. They come back 2 bars for railroad tracks. Either one of these entries is acceptable. They come back again and form up the second leg of the W. This is level 1 consolidation. See the pins? Hit the stops, hit the stops, hit the stops, hit the stops, rise. Hit the stops, rise again, change the pin to the top side and snag everybody. By the way, this is what I mean. This would have been the initial high of the day candle, or the secondary high rather when it's cut. This would have been the high of the day, right? The second bar comes in and takes out the high, but closes all the way down here, right? That's where it closed. That's railroad tracks to the high, where the second leg takes out the first. But if you know anything about candles, which I'm going to cover, when they spike to the high like that, they quickly snatch the market away from the higher level longs and send them into a tizzy or a panic. I don't know where I got this tizzy word from. My wife said it to me the other day, and it's stuck in my head now. I hate it. Sorry about that. They send you into a panic, right? You notice 2 bars is straight drop. Actually, 4 bars, 1 hour of straight drop. That 1 hour of straight drop, if you were long, sucks for you. You're freaking out right now. You're moving your stop. You're telling your wife to put on CNBC. You're trying to figure it out, right? Think about what they do. If you are long, they end the day back in consolidation, and you almost get out on either one of these 2 passes, but not quite turn a profit, and you tell yourself, I hate to lose money on this. I'll hold it overnight and see what happens tomorrow. Right? That's the old way you trade. That's over with now. The new way is to understand that the high of the day, you take a short in here, and in 3 bars you're out of the watermark on a spike to the 50 EMA. And if you didn't book your profit on the first pass, you got one more chance. Most of the time, market makers will repeat the level on a near miss. Our group knows to take that or to book a profit if you're in the other way. Okay? That's what I want you to start to understand. All right, here it is again. Here's your vector to the high, right? Pulsation to the high. It happened to be 2 railroad tracks to the mayonnaise. What's kind of cool about that is that the traders that take the moving average cross or break plus a close are now long. But we know it's the high of the day, and we know that they snagged a bunch of traders on this railroad track right here. Right? Then what do? They pull off, and they go into consolidation for about an hour. That consolidation keeps the retail traders hopeful. Right? Think about it for a minute. You've been in a trade, you're down 15, 20 pips, 25 pips. You go, oh, it's holding that level there, man. That's support from February 07. It ought to hold and bounce and continue on back up past the 200. Think of the mentality. That's also a rally-based drop, rally-based rise, whatever the hell that thing is. Rallies up, bases out, and rises up again. Some stupid textbook term. I can't remember. It's not important. What's going on here is people are calculating this in their little heads, and they're already planning on where they're going to take their wife. Right? They're projecting this move, and we know that it's BS. We know that it's not going to play out like that, and that they will correct off of the high of the day once it's established. And you know the trade is good because they pulled off and went into extended consolidation to hold the level. How long do they work these levels? 30 to 90 minutes. The 30-minute anomaly is this, railroad tracks. The 30-minute anomaly is 15 up to the high, 15 away. They spike it in 15 minutes, and they immediately get out of there in 15 minutes. That's where the 30 minutes comes in. But an ideal high setup is 90 minutes to about 2 hours. I could tell you that in the pound crosses, railroad tracks occur most often. The volume, for some reason, they must trap quickly in the pound crosses and get out of there. Okay? So here's what happens. You have your drop. This is the no trade zone, especially for the newbies. Okay? You should be in your trade and up, and you should be in profit like right here in 10 minutes. It's over. I'm exaggerating. An hour or so, you're out. No nursing. The trade goes into profit immediately. When you catch the trade at this hammer, let me toggle. When you catch the trade at this hammer or this railroad track, they shift the zone right here and go into consolidation and then shift it again. You're up in profit the whole time they're consolidating. Depending on the spread, +5, -1, +7, you're in consolidation. Somewhere in here, you're out. You got your +50 for the day. If you want to hold it, that's okay. The exit is the reverse signal after 3 levels of drop. You're not always going to get 3 levels intraday. Understand that. But now, look. Take these 2 pieces. That structure right there, right? That's as an outside bar, those 2 pieces together. If I put it on a 30-minute chart, those 2 would be together. That's an outside bar spiked to the low. Notice something else, too. When they hit the low again, you have your 3 hits to the low. This happens to come in at 9:45, and you have your consolidation to start the session above the low of the day that's established, right? It's safe to enter anywhere in here. The better entry is when they make the pass towards the second leg and fail to take it out. I'll cover the times on the boxes. Just enjoy the concepts right now. Don't worry, Robert. I got you, man. The trade is counter to the market maker trend. So the first target is the watermark, 50 EMA. Look to take between 30 and 50 pips on a counter to the market maker trend trade. Can it go for more? Of course. But you are counter his setup. If you're in A1 or V1, which I will cover, I'd rather you not counter for the day. Okay? Understanding the cycle, A1, V1 is a do not counter. Because the straightaway trade occurs most often here. Alright? Hope you guys are seeing this. Okay. Trading zone again. This is exactly an example of 3 hits to the high where you would have scratched out, and that's okay. But when they hit it again and didn't break it, you got something solid. Okay? The only thing I don't like about it is 2 hits are in one session, and the third hit is coming into the U.S. session. I like to see the hits spread out over 2 sessions. That is way more powerful because that means they accumulated for a while. But look at all this accumulation, right? Look what you got. Here's the high. You got your pushes up. 3 swipes at the high. This is variation on the theme. Okay, now, they hit it. They trade off of the high for hours. They come near it, but don't take it out. Notice how the pins have flipped to the top side. There's no bottom side pins. That is such a huge clue, I can't tell you. Notice on this slide all the top side pins. It's very important. Why? They run the market up, snatch it away, grab some traders. Run the market up, snatch it away, grab some traders. Run the market up, snatch it away, grab some traders. But I want you to see what's happening down. Look low to the TDI. The price is staying at the same level. I'm going to talk about the TDI, don't worry. The TDI is built on the RSI. The RSI averages the closes. So what's going on here is that taking an average of the closes is plotting a falling RSI/TDI line. That is telling you that these guys are averaging lower closes. What does that mean? If they're averaging lower closes, it means they don't want to go back up to the same level, and they're closing and jamming people every time. That's what it means. Okay? That's how you read the indicator the right way. That's how you explain divergence properly. The average of the closes is off of the high of the day in this example, and it is jamming traders on each and every pass. Hang on, Terry, I'll explain it. Okay? Yes, if you go long here, you're toast. But think for a minute. Look at the technicals, how they're set up. We got a watermark trading above mayonnaise. So that means the 50 is above the 200 EMA. That's a technical long in every book. You buy the dips or the consolidation zones in a downtrend, anticipating the AB equals CD, the 1618 extension, the lightning bolt's going to strike you in the head or equals whatever, right? Those are the technicals that we've all been taught in the books. Understand? Them holding the level ensures that the retail traders pile on the wrong way, not understanding the session changeovers and the market makers' targets when they come on. Holding that level guarantees that retailers are taking it the wrong way. Now, here's a little tricky one for you. Holding that level also allows them to work the Euro odd cross, AJ cross, or anything paired with Australian. Now think for a minute. They come out of the box, they issue 3 swipes and hold the high. They hold the high for 2, 3 hours, 4 hours, almost half a session, 4 hours. Holding the high does 2 things. Tricks the hell out of the retailers, induces longs, and allows them to correct an Australian cross on the backside when nobody's looking. This setup signals to you that there is opportunity in the Australian crosses. Understand? If they extend the high and hold the level, the opportunity presents in Euro odd, AJ, no, not Applejacks, Australian JPY. Anything crossed with AUD. Look on the big board, there's tons. Think about how powerful that is. You can come back on the third hit when they come back and change the session over, and you could still take this after you've had all night. Okay? Chasing this currency after it's left the station is an absolute no-no, or whatever you want to call it. I got to hit you on the hand or do my fingers, like shame on you. Chasing this after it's left is an absolute no trade. That's why this says no trade zone. When they shift the zone away from the higher level long holders, it's too late, man. There's ways to get in that, but it's for the advanced traders. I don't want you to do that right now. I want you to simply take a short off the high and a long off the low and be able to add contracts. Your entry is comfortable anywhere in here. The second pass goes, doesn't take out the high, you can enter in here 30 to 90 minutes while it holds. If they make another pass and don't take it out, restart the clock, the trade's still valid. And then look what happens. US changeover, they don't take out the high, lights out. Straight red bars, an hour and 30 minutes to profit. First consolidation zone, right? Then another drop. Simple. Do not try to, a lot of you guys are trying to turn this into a W. You have to understand they worked the high today. If they work the high first, you're looking for short opportunities. If they work the low first, understanding where the peak is, which I'll talk about, you have to understand they work the low first, you're a buyer against the trend. If they work the high first, you're a seller against the retail trader's trend. You got to think like these guys, not like a textbook retailer. Okay? Hope you guys are understanding. All right. We're going to cover some rules to profit by, and then we'll take a 5 or 7 minute break, okay? Here we go. Write these down. I'm going to go slow. Stop trading every day. Trading every day lines the broker's pocket, doesn't line your pocket. Now, I'm not saying take off and show up once a week. That's not what I'm saying here. What I'm telling you is you need to show up in your office every day at a set time. Look for the setups. I'm going to give you the window of opportunity when those two times come. If there's no setup, there's no trade. Don't sit there staring at the chart going, oh, man, maybe that's a second leg of an M or a W. I don't know. Might take it. You're over. It's done. That's it. I want you to find the crystal clear setups that form the big W's and the M's or multi-sessions, the easy-to-read stop hunts where you will be successful. What's the difference if you take 10 trades with one lot or find the absolute pristine setup you know is going to pay out and take it with 10 lots? Hit your 50, pick up $5 grand for the week and be done. And have no stress, no worry, no aggravation. That's how you got to start thinking. You got to start thinking like a market maker, not like a retail trader. That activity or the 9-to-5 mentality where you got to come in your office and trade every day because you showed up. That is crap mentality and leads to failure. Learn to become highly selective of the setups that I'm showing you. If it scares you, if the variation on the theme messes with you, that's a pass. I promise you there'll be another one tomorrow in more pristine condition than maybe the one you passed on. I promise. Okay, I want you to set your trading hours like this. Times are Eastern. I want you to show up in your office around 12, 1 o'clock in the morning Eastern Time. I want you to look for the setups at the end of the blue box, which is the last 1/3 to 1/4 of the Asian session, and go to about mid-London, around 4 hours. Take a break. Zen and his wife Diane have a lot of children. I lose track sometimes. They cannot stay up at night. They trade the red box in the morning after they leave their kids off for school. After you trade the Asian session, if you want to come back, and most of you do, you can't stand it, take a break, take a nap, clear your head, walk the dog, smoke a pack of Subio, then trade the red box for about 2 to 4 hours, from 8 to 11, 8 to 10, and that's it. Don't stand like a zombie and stare at the screen. It's not necessary. That's the behavior that leads to destruction of your account. Okay? And I'm going to, after the break, I'm going to explain to you why these rules apply. Yeah, Subi, eat some black chocolate, man. That's good stuff, especially from where you are in France. It's really good. Okay, so listen. Here's how you do. Show up in your office. You're going to immediately be able to do a check down on the chart. I'll show you how to do it. You look back 3 to 5 days, identify the peak formation, and see where you are in the cycle. WVVM, MAAW. I'll draw it for you. Don't worry. I'm just telling you about it. Okay? You know where you are in the cycle, what day of the cycle you're at. You have the technicals worked out. You don't have to draw lines and fibs and crap on the chart. Okay? Depending on your dealer, the blue box ends between 1 and 3 a.m. Daylight savings time, it moves back. I don't change mine. I leave it at 2 o'clock. I don't change it. When the clock goes back, I don't care. Just leave it. It's too much work. Become highly selective. Take a break in the middle. Come back for the end of the London session, the beginning of the U.S. session, and make sure you encompass the 9:30 equities market, U.S. equities market open, in order to be there for the brinks. Right? You got to encompass that couple of hours because they might come in and hammer a brinks for you, and you got to take that trade. If you're done in the London session and get your 50 pips, Marta, if you're listening, don't give it back in the U.S. session. Okay? I think tomorrow, or tomorrow's Thursday already, I think tomorrow Zen is going to cover what him and his wife do for the U.S. session. Okay? All right, it's 7 o'clock. Let me pull up my little stopwatch. I didn't do it yet. Hold on. Okay, I tried to answer some of your questions on the break that were pertinent to where we were. Coke, very nice statement. Thank you. He had an aha moment last night. That's the whole point, man. Okay, here we go. I want you to learn to capture 50 pips, and right now, not 1 pip more. You're going to be able to add contracts, man. Greed kills all good traders. Here's what I want you to think about for a minute. If you accidentally get jammed up in the stop hunt, you should still be able to book a profit going the wrong way if you aim for 50. Okay? So if you learn to not be too selfish or crazy or greedy or whatever the right word is, and learn to extract 50 pips consistently out of the market, even if you trade the wrong directional bias, you got a shot at hitting your limit. I can tell you that Zen is an excellent trader. But like all men, we got to get more, right? It's the testosterone. We got to beat these guys and beat the hell out of them, get more and more and more. And he struggled with this when I first taught him about 1.5 years ago. He insisted on trying to lift his take profit and go for more, and I told him why. A lot of times when he lifted it, he would end up with plus 30 or 35 because they would make the retracement on him, and he would be damn it and take his 35 pips off. When he locked in his mind, the take profit needs to be a fixed target, and he'll be in and out in 3 to 5 bars. When they shift the zone and start pulling away, he'll hit his limit and just start using contracts to compensate for the extra pips. His trading turned around completely, and he's now, I can't say he's the master because I think I am, so he has to be the junior master. Anyway, greed kills all good traders, and everybody goes through that phase of where they feel like they can get more and more and more. Don't forget why you got in this business. Time, freedom, and leverage. Use that to your advantage to extract your 50 pips like a master without fail, and add 5 lots or 10 lots or 80 lots when you become proficient. If you know that you're going to hit 8 out of 10, the losers aren't going to bother you because you know you'll get it right back and end the week net profit, net positive. I want you to learn to take only crystal clear setups. Whatever that means to you. I went through this with Lauren last year. I wanted her to pick her signature. And I don't know if she ever did. I can't remember. She sent me an email a while back. She liked 2 pins to the mayonnaise. That was her deal. If you get a stop hunt at 3:30 in the morning and they hit right to the mayonnaise and they issue a pin or a hammer right on the mayonnaise, that's a nice setup. That's going to pay out. That's going to bounce off of the 200 EMA. I'll explain to you why in a little bit. But what you need to do is find what it is that makes you feel all gooey inside. Like, wow, I see that 2 pins in the mayonnaise. I see a W on the 4-hour. I see 3 swipes at the low. When you establish that and become comfortable with it, I want you to focus your homework on that. If you say, Steve, you know what? I'm going to take 3 vector candles to the low, second leg, and I'm going to grab my 50 and be out. Then you need to focus your homework on finding those trades and see how often they pan out. If you decide you're going to focus on multi-session big W spread out over a day or two and then convert the spot trade to a swing and hold it for 2.5 to 3 day cycle, 200 EMA, my friend. Mayonnaise is 200 EMA. I'll cover it, don't worry. If you catch the midweek reversal or the big W formation over 2 sessions, that's the kind of trade you can hold. If you want a swing trade, obviously you got to hold for more than 50 pips. But when you're learning, if you can't make 50 pips, how are you going to make 250 pips? It comes with time. It's a process. The biggest problem most of you are going to have is flushing the crap out of your head. I don't know how to do that. The old technicals. Coke wrote me a little something on the break that he was hanging out with some of his friends, and they took the wrong directional move based on old technicals, and he said he felt bad because they were going the wrong way, and he knew it. He saw the market through a market maker's eyes or through our eyes as a group and realized those guys are going the wrong way, man. Sorry about their luck. Anyway, that's the stuff I want you to understand, is that if you see the perfect setup, you can take 50 contracts without fear of loss. If you're trading a 6 out of 10 system and you're not that good at a 6 out of 10 system, how in the heck are you ever going to put those kind of numbers on comfortably without fear? Okay? But I want you to understand that if you say, I'm going to take multi-session M's and W's, you go back and look how many times those things pay out 50 pips. Almost always. And you're going to see that the ones that don't hold consolidation and scratch out. When you realize that, which comes from time, screen time, and doing the homework and seeing them, when you realize that, you're going to not be afraid to put 10 standards on there. I'm not telling you to take 10 standards tomorrow. I'm telling you to start small, grow your account, and get yourself into a position where you can take comfortably 2 to 5 trades a week, 1 a day, of the most pristine, perfect setups that will yield you what you need to make to pay your bills and be comfortable. Everybody's different. If you live in New York, you've got to have like 500 trades a week. If you live in Nebraska, you probably got to have 2 trades a week. Depends on your lifestyle. But it's all obtainable here by understanding how these guys behave and controlling your emotions and your greed in the process. Okay? All right. Why 50 pips, Steve? I want to go for 500 pips. Okay. You are not going to deal from the absolute bottom or the absolute top. So let's take 10 to 15 pips off of that number of the move, right? You got to include the spread and slippage that these guys do. That's the business. The bigger your contract size is, the more you'll start to see it. Let's add 5 for slippage and the spread. You got a 2-pip spread, they slip you a pip, 3. It's a lot of money with a lot of standard lots on. We all know that all 3 levels are not going to appear every day on the chart. So that limits you to what's going to be available to take. So if you average level 1 and level 2 from the peak formation to the high-low day consolidation zone, you got about 70 pips available to you if you have a tight ADR for the day. You can easily grab your 50 pips out of that float and grab most of what was available for all the other traders and come out way ahead of the curve. The bottom line is this. I don't know if DJ's in here, but he wasn't seeing the pattern so clearly. But because the stop losses are so tight when you get in near the low or near the high, 7, 10, 15 pip stop losses. I don't say that in public because people think I'm nuts. Hey, Doug, nice to see you, buddy. I hope I'm not embarrassing you saying this, but he had a bad week where he had more losers than winners. But because the stops were so tight and he was taking 50 out of the market at will, he was net profitable. I want his numbers to be better, but the bottom line, while he's training and learning, he's still making money. Because he's getting in close to the numbers. Sometimes he's wrong and he hits a stop, but it's 10, 15 pips and he goes again. He can have 2 or 3 stops, and when he hits one, he gets it all back for 50 pips. It's called controlling your losses and your emotions. Hey, Zaim, if you understand what's going on and how they structure the stop-loss levels and how they hit it, you can come right back at them. I once heard, in a school somewhere, I don't want to say the name, they said if you get stopped out, to go on vacation. And they really meant it. You do not want to be on vacation with me if I just got stopped out. What fun is that going to be? What I want you to understand is that when you analyze the market conditions and you get stopped out, if you walk away and come back the same time tomorrow, you could fall right into the same conditions. If you get stopped out, anyone want to take a stab at how long you wait? 2 hours. Why? If they go vector 3 again, 3 bars takes 45 minutes. If they spike the low and go back into consolidation, that will take another hour or so to set up that structure. If they spike the low again, that's another 15 to 30 minutes. There's your 2-hour time window for re-entry. The structure must be 25 to 50 pips above or below your previous entry. If they hold the level and pass a third time, and it still is also 2 hours, and they might have snapped you out with a pin and closed below or above that structure, that is still a good entry. I'll draw it for you, don't worry, I just want you to listen. Okay? So if you take a trade right out of the London box and they vector down, it looks like the W to you, and they hit your stop, you don't walk away. That's what amateurs do. You analyze the market condition, wait for the next level stop hunt and strike zone, and you strike. These guys vary the levels to keep you confused. There might be a 4-hour line laying down there. They might come out, hold the level, and then go, there's the 4-hour, bam, and go get it. That might cause you to get stopped out. Control your stop and enter on the next strike zone 25 to 50 pips below where you just were. And I'll illustrate this. I just want you to hear it. I'm trying to give you the concepts for the next couple of days. You have to listen. Don't worry about the charts. Don't worry about your indicators. Don't worry about stuff you cannot see. It's irrelevant right now. I'm trying to get you inside the head of these guys, the mind of a market maker, and understand how he handles the market. This knowledge by itself is invaluable. Don't worry about the chart stuff. We'll straighten it out, I promise. Okay? If you listen to the rules I just laid out for you and wrote them down, there's a good chance you will hit your limit every single day. Or every time you take a trade, if you wait and exercise patience. The thing that's kind of crazy is you can trade both ways against a trend and against the retail trend. So that means you have an opportunity to book profit in both sessions from both ends of the range. You can take a short off the M and a long off the W on the extremes of the range and be profitable both trades. And book yourself 75 to 100 pips consistently. 50 on the first trend move, 25 to 50 on the counter. Going against the retail traders. Market makers trade both ways every day. Why would you have fear to follow them and trade both ways? You can average 100 pips a day doing it this way. Combination of pairs, let's say you take Euro, GBP, CHF, you bag 50 in the London session on all three pairs. That's $1.50 times your contracts. Then you can take the counter in one or two pairs back to the watermark on the ideal level 3 drop setup W back to the watermark. Another 40 to 50 pips. Or until the pair comes to rest into consolidation. Understand the extremes of the zone. A sucker trades in the middle and offers up your stop loss for these guys. Learn to be selective on the extremes of the range. If you're only studying one pair, that's perfect. Sunny, I don't know if she's here. She told me she got so profitable she ain't wasting her time taking my seminars anymore. I don't know if I should be proud or insulted. She focuses on Euro USD. She took about a $500 account to $8,000 plus in a few months. Focusing on only Euro USD and trading both sides of the range, understanding their behaviors, and mastering that pair. Trent, I don't know if he's here, has been chasing the pound USD for years. It was driving him crazy. When I gave him the last piece of the puzzle, he beats the crap out of the pound on a regular basis for multi-5 figures a day or in a couple of days. By the way, you're probably going like 5 figures. What is that? Not 5 figures a year, 5 figures a week or a couple of days. Okay? That's the power of understanding what these guys do. I want you to understand that. Once you master this, you're going to have no more fear. The market's going to be easy. Okay, so now, here's what we're going to do. Let's start to break the system down, the things on the chart that you guys have been bugging me about. And let's start to break them off, put them all back, go over the boxes, the times, the averages, what you're supposed to look for, how price action is supposed to behave, the structure of an M&W. That's what we're going to cover. Okay? So let's do it. The components of a system. I don't care what system you're trading. I hope it's mine, and I hope that you throw everything else out. But you got to have a reason for entering the market. You can't just go, I like Euro today, I'll take it. This has to be called your setup, right? It's got to be based on some fact. Level count, trend direction, peak formation, high, low, where you are in the cycle, V1, V2. You got to know where you are in the cycle, and you have to have a setup at the appropriate times for it to be valid. That setup is your reason to buy, sell, or stay out of the market. Simple, right? Easy. Easy stuff. In addition to it setting up, there's got to be a signal presented to you. Second leg pin. Issues on a hammer 9:30. The high or low is formed. The high of the day is formed. Second leg issues a hammer at 3:45 a.m. It's got to be a confluence of triggers. The confluence of triggers has to be all these things that I've been talking about for the first day and a half, has to come together at the right moment in time. Okay? 50 pip, Tokyo channel, Asian range, market maker spread. Call it what you like. They come out of the box. They have 3 vector candles to the high. It happens to be 25 to 50 pips above the top of the box. Market makers quickly pull back and go into consolidation. The second pass comes in, fails to take out the previous high candle, ends on a railroad track, forms out the perfect M at 3:45 in the morning. That's a setup. The pair's been dropping for 3 days. It's at level 3. It's chopping. It's erratic behavior. I notice the pins are to the downside. There's a spike to the low outside bar in the Asian session. Market makers come out at London at 3:30, and they spike the low, but barely miss it, the blue tracer by a hair. They turn around and issue railroad tracks a half hour later at 4 o'clock. That's a setup. Okay, those are the things that have to come together. It's the signal and the confluences that all come together at the right time. Okay? That's what I'm talking about, putting it all together. And you will be able to do that. Okay, everybody knows this, but for some reason, this is in every book, and I happen to agree with this one. You got to have a fixed stop loss, man. You can't be like, I put the stop here if I feel like it later. And let me tell you right now, I've heard this before, and if you're doing this, stop immediately. Mental stops do not work. All right, let me say it again. Mental stops do not work. Because you always think it's going to come back, you always think you're right, and you'll go, a little bit more, I'll cut it, a little bit more, I'll cut it. If you're going the wrong way and they're shifting the zone away from higher level longs or lower level shorts, they ain't coming back, and you ain't getting out. The cheapest stop loss available to you is the first one in the right context of the market, and I'll show you where that goes. Right? Mental stops are for mentally retarded people. Don't do it, okay? You got to have a way to protect your profit once it's achieved. I've met people that can pick perfect M's and W's. They get cocky by Friday. They do one stupid trade and give it all back because they can't believe they're wrong. Is that on my tab? I can't help you with that. Those are the kind of behaviors that you got to deal with. You need Norm. Spend some time with him. You need to fix your mental edge of the game. I can't help you with that. That should not be on my tab. You got to deal. I'm going to show you where the stop loss goes in the right context of the market. I'm going to show you how to pick the perfect entries and where to take your profits. If you lift your stop loss, I can't help you. You got to beat this demon yourself. You got to beat it down. There's nothing wrong with being wrong for 15 or 20 pips and bagging 2 or 3 for 50. There's nothing wrong with that. You can be wrong. It's okay. It's better to be wrong quick, get it over with, and look for the next level strike zone. And I think what happens prior to this class, you're so happy that you finally think you got a decent setup that you hate to be wrong because then you got to look for another one, and you're scared to death to find another one. So you're like, oh, man, I thought this was a good setup. Let me just hang on, see if it comes back. I think that's what happens with a lot of people. But once you understand how the structure of the market is set up, you're going to be able to get in and get out both directions, both ways, all the time, anytime. You're not going to be afraid anymore. You should have a calmness come over you. Okay? You got to have a strategy to protect the profit once you got it. Swing traders, you got to move to break even. When you're up 50 to 75 pips, you got to move the stop in behind the next strike zone stop hunt into the next level. We'll talk about it, okay? My favorite is a jumping stop where you manually jump the stop. I do not like a trailing stop. And the answer is simple. Why? Who provides a trailing stop on the platform for you? the dealer. That guy ain't your friend. I've met more good traders that have been trailed out by a trailing stop, and they were going the right way because they didn't understand how to jump into the consolidation zones. Now, with that said, if you ain't going to sit up all night, I'd rather you trail the stop than do nothing, because it's a crime to be up 45 pips, miss your take profit by a hair, and come back and wake up to a stop out. That's unacceptable. That's a 40 to 60 pip swing against you, in your favor and back against you, and you ate the stop. That's a crime. I don't care what country you live in, that's a crime. It's high treason to the method. Okay? The goal is to preserve your capital while you're learning and to grow it. That's the business. If you can treat a demo like real money, I applaud you for that. I'd rather use a demo while you're learning, because I want you to preserve your capital. But if you cannot and you have a couple grand, why not open a micro with $500 and practice with real money and leave your other equity set aside? That's a better strategy. And then when you become successful, you have all your equity left. Okay? Important. And if you do like Casey, where you take a small account and triple it, you'll have more equity to put on top of your equity. It's just a better way to go about it. Yes, Nick. That's true. Okay. Trading systems continued. You got to have a profit target. It's got to be fixed, projected, or based on stops for swing traders, or based on the reverse signal when you become proficient in understanding. If the M is the entry, then of course the W or A top is the exit. Right? I'm sorry, if the M is the entry, the W is the exit. If the W is the entrance, the M is the exit. The opposite signal at the appropriate time is the exit. If you insist on taking the entire run of 255 pips, that's okay. If you grab the low, even if it comes back into mid-range consolidation, you'll close the day around 50 pips. Think, they spike the low, they raise price all the way up. If you don't move your stop, and you were right today, which you should be, right? They're going to come back mid-level. If you never moved your stop, you're still good. You're going to end up with plus 50 or so in here, depending on the ADR of the pair. But why when this was the exit? Okay? It'll come. It takes time. It's a journey. It's a process. But the rules that are used by regular traders, because you do not have unlimited equity, apply to you, but just using them for our methods to trade. Okay? Okay, you got to have money management. When you're learning, I want you to use about 1% risk. One mini lot, one micro lot, depending on your account size. We'll talk about that. There's a sheet provided. You got to have a way to manage your money. And if you don't know how to figure out your stop loss, you take distance to stop times lot size, right? Lot size times pips, or distance to stop equals your risk. Take that as a percentage of your account. Okay, if you have a $5,000 account, a 10% risk would be $500. A 1% risk would be $50. Okay? When you look at some of Rick's statements and trades, I don't know if he's in here or not, he does ramp up his risk. But I can tell you that he ramps up his risk on small accounts after he's already made multi-six figures trading this way. So if he burns $5,000, he don't care, because he'll come right back at it. If it's your last $5,000, I want you to treat it like it's your last $5,000 and trade it with respect, and don't burn your equity down. When you make multi-six figures and you want to throw $5,000 and trade 50 standards and go crazy, that's okay. But let's make some money first before you start doing some of the stuff that Rick does, all right? Rick, I'm not picking on you. I love you, man. I just want to make sure that they don't look at your statements and get jacked up. All right? It's doable. If I can teach one man to do it, I can teach any man to do it. Yes, 1% risk initially. First couple of trades, get comfortable, make sure you're seeing everything right. And if you could do it on demo, even better. But if you don't treat demo right, don't use demo. Use micro. Okay? And if you don't know where to deal from, that's what Kim and Compass are here for. Contact them immediately and get you set up at where you need to be. Let them do that for you. That's one of their tasks here with us today. To get you dealing from the right place, a place that has micros, a place where they're not going to trigger your stops every 5 minutes. We want you to be in the right dealers. Okay? All right. Understand, very important, that the market maker pattern that I've drawn for you and laid out for you outweighs any man-made indicator. All right, let me say that one more time. The pattern I've so far illustrated for you outweighs RSI, TDI, moving averages. It outweighs everything. And I always say this, the pattern is the top 3 things you need to be concerned about. You react to the market maker's actions, you will have profit. You will be successful. In order for us to understand how to read charts and identify the market maker's intentions, I took some widely used indicators and applied them to a chart to help us understand the timings, entries, and exits. I took the work time ribbon that somebody made in Russia and I programmed it, or had it programmed. I don't program nothing, just kidding. Had it programmed to match the Tokyo channel and the US session reversal. I took some shadow boxes, thank you, Ray, and put in the key times when market makers issue the Brinks trade. That's what the shadow boxes represent. They represent the times when the Brinks trade will present the stop hunt zones, and I will cover all that stuff, don't worry. Divergence in TDI and RSI, the bands. I'm going to explain how to use all that in conjunction with our methods. But understand the students that are having more success, as they move forward in their success, they shed the crap off the chart. Okay, I wanted to announce to everybody, Ray mentioned this to me and I forgot, and he just reminded me, that he is currently coding a new version of the work time ribbons that will automatically ping the broker server, grab his GMT time or the broker server time, and match it up to for our needs. It'll be ready soon. I don't know when. If you want to bother someone, bother Ray. I'm going to put his phone number up here in a minute. I'm kidding, man. We're not going to do that. I know, it'll be ready. So any broker that you drop it on, the boxes will shift necessary for our methods, okay? It is going to be good. Since most of you know how to use all these indicators and have fallen victim to popular technicals, using them allows us or you a faster transition. You know what divergence is. If I could show you how to spot divergence during the stop hunt in context of what we're doing, you're going to pick it up faster. If I could show you how to pick a hammer, which is a common candlestick pattern, at 3:45 in the morning, second leg of the W, you're going to pick it up faster. So we've incorporated some of the standard technicals onto the charts to help you see. The goal and the dream for all of us is to shed that stuff and trade maybe the boxes, the ribbons, time ribbons, and a couple of maybe moving averages for where they're going to form the zones. Stop hunt to the mayonnaise, reversal. Okay? That's what I'm talking about. Okay, for the purpose of this class, the EMA 5, 13, 50, 200, 800 will be used. How do you remember? Mustard, ketchup, water, mayonnaise, blueberry pie, whatever you want to call it. All right, here, look. Mustard, ketchup, water, mayonnaise, blue. Blue whatever. Okay? We're going to cover some basic candlestick patterns. Hammers, railroad tracks, spikes to the high, outside bars. It's not stuff that you haven't already seen. I didn't invent them. Candlesticks have been around since the 1600s. I think when they used to trade rice, they used to use them back in the day, commodities. But here's the thing about them. A hammer in the middle of a run is worthless, in my opinion. Steve Nissan will probably yell at me. But here's the deal. A hammer issued at 345 or at 945. A hammer issued as second leg of the M or W formation, understanding the context of the market where you are, will help you to understand our setups faster because you've studied this stuff. Okay? Railroad tracks, double bars, or if you're using a bar chart, railroad tracks look like railroad ties. Is simply market makers run up there, grab the orders, and come right back down, or vice versa, down and come right back up. Understanding that right out of the blue box as three vectors on one side and then the railroad track pulls away, that's going to help you understand the setups. Okay? We're going to use color-coded sessions. The work time ribbon codes the sessions for us to understand where we are in the cycle. I'm going to cover it. You got some crossovers, arrows with alerts. We use 513.50, right? The 513 crossover is the signal line. Here's the thing about the averages. If you wait for the average to cross, you're kind of late to the party, and that's not what I want for you. The 513 cross fires most of the time when they shift the zone away from the level traders. When they shift the zone down from higher level longs, the 513 will cross. When they shift the zone off of lower level short holders, the 513 will cross, the arrow will fire. A lot of times, that shifting of the zone will put you into monster profit immediately. When the arrow fires, it is not an entry signal. It is a confirmed confirmation that you are still in the right direction. Okay? Moving averages in the wrong context of the market are worthless. And I mean absolutely worthless. It's like trading spaghetti, right? Sideways, chopping. The moving averages in the Asian session, they're worthless. The moving average crossover after the stop hunt and the W or M forms, and they shift the zone and the arrow fires, confirmation I got it today. That's what we're going to cover, how to use them in the right context of the market maker patterns. And because we're using stuff that's common technicals, the transition will be quicker. Yesterday's high-low, high of the day, low of the day, HOD, LOD. It paints on the chart as a light blue marker. And I cannot say enough important things about that light blue tracer. If yours is not working, if it's not painting right, if something's wrong, if they're smashed together, those things happen, I'll send you a fresh set of indicators. We'll zip the file up and get it to you. Kanan can do that for you. Pivot points. Pivot points are kind of crazy. They're intraday support and resistance. Here's what happens. A lot of the times, you will get your 3 swipes at the low right to an M1 or M2 pivot. It'll pull back and make the second leg at the same pivot point. That just helps you to trade. Do you need them? No. The pattern, the pattern, the pattern. Some people like them, some people don't. I'm not offended. I didn't invent them, but there's some targets on the chart that help space out where the stop hunts may occur. You have the boxes. If you don't like the pivots, get them off of there. TDI, can't say enough good things about TDI. Dean wrote it, but in the context, the way we use it is a little different than how he uses it. And I'm going to show you. We have trades called shark fins. I think Dean calls them hooks. We have a trade called shark fin long, hold the mayo. It's not a sandwich. Shark fin short, hold the mayo. I'll talk about it. When these signals appear in conjunction with the market maker behaviors, solid gold. Back up the truck. Brinks. The third most important element of the system is the market maker level count. A lot of people struggle with this. And listen, I'm no exception, man. I'm not some Harvard scholar. Sorry, Masood, if you're in here. I'm not making fun of you. It took me a while to figure out what the hell this guy was talking about with the levels. I suspect it will take you some time also. But understand this. You can and will be profitable identifying the market maker patterns and the timings. The levels will come. Okay? They will come to you, I promise. ADR, average daily range. I've seen ATR, average true range. We go back 15 periods, Intraday is 15 days. Gotcha, Maseo. We take an average of those 15 days. You know how an average works. The last one drops off, the next one is calculated. It takes an average of its behavior and plots a couple of lines on the charts. A confluence of events. Remember what I said, a confluence of events? Multiple things happening. Think about all these things that are up here. If tomorrow market makers come out of a 50-pip box, right? And they spike the low, they issue a hammer at M1 pivot, you get a shark fin and TDI, it happens to be level 3, just outside the blue box, right to yesterday's blue tracer at the low. This would be a confluence of things coming together. Understand? That's what I'm talking about. And these are the things over the next day and a half we're going to strip down and build back together so you can understand how to find these signals, the proper signals. All right? Just because market makers make a small consolidation zone, do not mistake that for an M forming, Tony T. That is not an M or a W forming. You have to know where you are in the cycle and the proper timings and context. Yes, Peter, exactly. Multiple things came together on Euro CHF last night and issued you a perfect entry signal. Rob, it's up to you. If you see it right, it is. We'll talk about it. It's got to work for your personality. Okay, so what we're going to cover is the trend, evaluation, and count. I'm going to show you the difference between the market maker trend and the retail trader's trend. How to check down what to trade. Boxes blown out, you pass. Certain behaviors, this pair's at level 2. Best time to enter the trade. I kind of told you already, but I'll cover it again, a little more spread out. You can't hang around and wait for something every time at 345. You might miss the move. And then the most important thing, how to manage it while it's on. That's what I'm going to cover over the next day and a half or so. Okay? The trend. Is everybody good? Okay, cool. Hey, Sean, I didn't see you there, buddy. Thank you, thank you. Paul, need some ribs from Back 8 Barbecue over there in Texas. Okay, good. All right. The trend. How do we identify the trend? We know there's two types of trends. There's the retail trader trend, what he wants you to see. There's the technical trend, what the rest of the world is looking at. The market makers perpetuate the technical trend and make you see it. They validate those signals on purpose. It's a dirty business, man, but that's what they do. The levels are visible on all time compressions, but I feel that they are visible on the 1 hour chart, highly visible. Some people like the 4 hour. Zaim happens to like the 1 hour. Carr likes the 1 hour. Some people can't decide, so they take the 15-minute and the 1 hour, cut it in half, and use a 30. I don't care. I want you to do what works for you. The point is not to fill my ego. The point is for you to see it. So don't use what I use unless you really and genuinely see it. I'm not going to be offended, man. I want you to get it. Okay, keep this in mind. Hey, John, how you doing? The trend is set by the market maker and can be reversed at any time for no reason. The real reason for him to change the trend is because the dollars are getting out of whack and he needs to get them back. Understanding this, that it goes both ways, gives you a major edge. It allows you to stop thinking about the technicals and that, oh, in a downtrend, I only take rises and sell. It allows you to say, anytime it bottoms out, I'm not going to wait and buy. It allows you to take it down to the buy level and then back the other way. Don't get so caught up in your baggage or bias that you miss the good setups because you think it's supposed to go this way. Market maker hits the stops high, you're a seller. Market maker hits the stops low, you're a buyer. In line with peak formation, second day V, good stuff. Got it. Okay? If I'm going too fast, please let me know. This is important. This is how to establish the trend. Now, I like to think everything I say is important, but this is pretty important. Okay. The trend is generally set up as a 3-day cycle. Day 1, there can be multiple rises inside of day 1, but day 1 should be level 1 rise back into consolidation after the anchor point is formed. Okay? It's reversal day. Peak formation is formed high or low. Second leg W. Second leg M is formed. What's kind of cool about knowing what you know now is that day 1 comes as a market surprise. What do you mean? It catches all retail traders off guard. And then it's aggressive. Look what happened Sunday, Monday. 3 hits to the top, the trend was up. Just kidding, dropped the bottom out of it. This catches everyone following traditional indicators and trend following strategies off guard, retail traders. The news is used to perpetuate false trends. Okay, my D fell off. Thank you, Gloria, for my English lesson. If you're at, you see the anchor point W, right? And then it rises up and pulls back, and the next night there's news. They'll make a V bottom right around 3:30, and if the news comes out at 4:15, whatever it is, they will spike in the correct direction to continue on with the market maker trend. So that's why I told you in the presentation the news is crap. If they happen to have trapped lower level shorts when the news is released, they will rise price. It doesn't matter what the news says. The news might say, oh, the pound's weak, and then the pound will still rise. That is simply because they have to complete their targets in their cycle irregardless of the news or regardless of the news. Okay? Yes, the news is BS, man. I said it and it's true. The news is pure crap. No, I'm not saying not to pay attention to the news. You need to be out or flat on the red releases. I'll talk about that. But for argument's sake right now, don't say, oh, the news said that there's less jobs in the U.S., so dollar-based pairs will drop. That's not true. What's going to happen is, depending on where market makers are in the cycle, they will behave based on that and nothing else. Okay? If they're at peak formation high, they'll hit the stops high one more time when the news is released and then drop. That's how they do it, and that's why they do it. No other reason except for the money. That's why the news doesn't match up with the way the currencies move. That's exactly why, because it doesn't matter. Okay, day 2. Okay, so you have day 1, peak formation is formed, comes as a market surprise, reverses, right? Day 2, the moving averages on the higher time frames will signal. The 5200 on the 1-hour chart might cross over. Traditional indicators will cross over and fire a signal. Zero line MACD will cross. CCI might cross. RSI might cross the midline. Retail traders wait for confirmation and validation to enter the market, right? I can't think of who it was, but someone had a system where MACD crosses the zero line on the pullback. It has to take out the next bar. And when it takes out the next bar, you enter the trade or some crap like that. That's called a validation of a signal. Retail traders wait for this. Waiting for this forces them to lose money. But here's what happens. If the traders aren't committing their funds, market makers aren't making any money. We all know they're in the business to make money. So by executing a move in such a way on day 2 that forces the moving average crossover, the indicators to cross the 0 line, or certain indicators across the 50 line, it fires a signal. And to come back with a false move again towards the high or towards the low validates those signals. Understand? It's on purpose. That's why when you get a signal and it validates and you take it, it doesn't always work out. You were in the wrong segment of the market when the signal got validated. You were in stop hunt high, and you took it as an extension continuation because you had MACD confirmation. It broke the previous swing high. That's why that shit doesn't work. That's where the pin comes in on the second leg and snatches you away and grabs your orders. Exactly. Market makers force the hands of the retail traders to get them to commit their money because, after all, objective number 1 is to get you to click the mouse. If that money sits there on deposit and doesn't get into open float, it's of no use to them. Ah, sneaky. I brought that all the way back from day 1, slide 1. Understand? They know what they're doing, man. It's a big carnival. They validate the technicals on the chart. They show everybody the crossovers. They show everybody the 0 line crosses. They validate the swing high with a spike, picks up the orders, right? Gets the breakout traders to fall, snags them. Bingo, got them. Okay. Day 3. Remember? 3 psychology. Traders are now convinced that this is the real move. Market makers show a thing called trend acceleration. That's when you get separation from the moving averages. The averages are fanned out. You get vector candles at level 3. The vector candles seem to be a monster amount of momentum entering into the market. Some people might even say, one of my pet peeves, risk appetite's in there. Hate that. Okay? You start getting vector candles on the last day of the cycle, and you also will see a 33 trade. Yes, Ziva, it does work. It does work, or trades won't be around, but those are 50, 60% systems. I mentioned earlier, the news is used to further the cause. Just when everybody sees it going a certain way and they get excited and want to take the trade, market makers hit the brakes and trap everyone except us the wrong way. Okay? All right, so now we have a 3-day cycle. Day 1, peak formation high, is usually the end of a trend cycle. Catches everybody off guard. Market makers trap the higher level longs, lower level shorts, and snatch the market away from them. They come back, form out the M or W, which is our anchor point to go the opposite way. That move validates all the retail stuff that's out there. The news could help to trigger that. Could time it right at 4 o'clock or right at 8:30 U.S. time to get the news release to coincide with it. Day 2, the new trend is underway. Market makers must force the hand of the retail traders to commit the funds the opposite way they were previously going. How do they do this? They perpetuate moving average crossovers, 0 line crosses, RSI 50 line crosses, CCI line crosses, whatever the indicator people are using. They force those to cross on the higher time frames. Most people trade multiple time frames. So the extended trend run forces all those charts to turn over. The 3rd day of the cycle, vector candles, acceleration towards the high. This also applies intraday, by the way. The vector candles, acceleration, pins turn to the top or bottom side. Pins turn to the opposite direction of where they're going to be going, or the current direction. If you start seeing pins issued to the top, pretty sure you're in level 3. Okay? If you see pins issued, pull back, again, pins issued, pull back, you're in level 3 of the cycle. Understand that. Market makers apply the brakes, trap everyone except us the wrong way. That's the 3-day cycle. Now this cycle in 3 moves also plays out intraday. Remember I showed you? Peak formation low, stop hunt, rise off of the low, hit the stops, rise, hit the stops, rise, hit the stops high. One direction, unidirectional stop hunt. Snatch the traders, pull away, validate the pendings, one more pass, pick up the breakouts, grab the guys that were in the right direction by stopping them out or scratching them out at +1, and then on their merry way the opposite direction. Okay, I'm going to draw this stuff for you. Okay. The reversal in the market is used for market makers to book a profit. Okay, price is rising, rising, rising. Couple of days, everyone's long, everyone's long, everyone's long. They're buying from the traders, so they are net short. They got to get out of those positions or offload them to book a profit. The spike that you see before the reversal hits the stops of the people that are right, puts those contracts in their pocket, and induces people to take more longs. Those contracts will end up in their pocket as well. Think for a minute, man. Do you really think the broker's matching you up with some dude in China? And if you're in China, do you think he's matching you up with some dude in Italy? Do you really think that? Or is he, in fact, taking the other side of your trade and hoping that you haven't had this class? That seems more plausible to me. Okay, I'm going to break here. Is anybody writing the slide down? Please, I'll leave that slide up. I'll put the clock up. I'm actually starving today for some reason. I don't know what the hell happened because I ate. But it's 8 o'clock. Let's take our 30-minute break. I want you to think about what we've talked about so far, the trend cycle, stop hunts, all the things. And I'm going to start breaking things down for you. Okay? All right, I'll pull up my little, let's do 30 minutes. I don't think that's too long. I think it's good. We're going to go to about 11 o'clock tonight. Around 10:15, depending on where I'm done, Carr, one of our top students and traders, is going to hop in here and show you how you're supposed to be marking the charts and actually teach you how to do it. I got a lot of emails last night from people saying, man, I've never even tried to mark a chart before. I don't know what to do. So I guess it would make sense that before I give you the homework that he would show you, in fact, how to do it. The veterans that have been around, you can knock off tonight around 10:15. Okay, the new guys, I want you to submit your homework in this format and start to see what you're looking at on the charts properly so we all can be doing it the same way. So when you post in the forum, your charts will match other traders' charts that we're all working on together, okay? All right, let me get my little clock, take a break. Couple questions. Let's see. Dave asked me, is it okay to trade in the changeover shadow box? Absolutely, Dave. The changeover shadow box is where you expect the stop hunt to come in. Is it always going to line up right there? Absolutely not. But if the pattern, you trade the pattern. The boxes are a guide. If the boxes don't line up, don't not take the pattern because you think it's supposed to be in the box. Understand? Let me run this by you real quick. I usually say this every class, and I failed to say it this time, so let me say it now. For the first couple of 3 days, you're going to be confused. You're going to be asking me about the indicators. You're going to be asking me about the boxes, this stuff. I promise you that by the end of the 3rd day, okay, so tomorrow night, 3rd day of my teaching, not 3rd day of class. By tomorrow night, things should start to come together. Okay, if they do not, then you need to send me an email and tell me what's wrong. Okay? Anybody having technical problems? I think Zen has a way for you to call in. He can help you load Java. I don't want you to miss out. The recordings are going to be hung in the forum for 2 weeks. So if you miss a night or you have issues, just get in there and write down the time you went down and then convert the recording over to the time you need to pick up, right? Like it's 8:30 now. If you went down from 8 to 8:30 during the lunch break, then you're good. If you went down from 7:30 to 8, that's the section you need to watch, okay? Just make a little note next to your computer and say, man, I didn't hear that part. I need to hear it again. That's the point of the recordings. You could start and stop them. Okay? Nice to see you, Alan. Back in here. Thanks for the no problems. Okay, so we left off on the chart about hoping he didn't take your class, okay? So seriously, if you're confused, just relax and listen and try to observe and pay attention. I promise you, I'm going to start hammering all these concepts together. What I'm doing is I'm throwing a bunch of concepts at you, and then I'm going to wrap them all up and bring them back together by the end of the sessions, okay? The idea is for you to realize that there's something else going on. These guys suck, and they're trying to take your money. And understand that you can beat them when you trade in line with them. That's what you need to understand right now. I'm going to repeat the concept enough times that it should stick in with you. It should stick to your brain. If it doesn't, that's the point of the recordings, okay? I don't want to waste too much time on that. Continuation of the trend slides we were looking at. Not continuation of the trend, continuation of the trend slides. A trend reset will be used for market makers to book a profit but not reverse directions. Right? What happens? Give out their money, give out their money, give out their money, need some back. All right, but you know what? The target is that euro still must rise to a certain point. So they reset the trend by forming another anchor point, V or W, and then they break the previous high and continue on up for another 3 days or so. A reset will represent a new peak formation, high or low. Then you can expect 3 more days of rise or fall. However, very important, if no trader falls for it, the market maker may reverse the direction after only 1 more level or 2 more levels. That's why you have to understand his behavior in order to understand where you are in the cycle. Right? Things that I started talking about. Am I near the high of the cycle or the day, Steve? I don't know. Is he opening the spread? Are the pins switched to the top side of the candles? Have you seen vector and acceleration and speed around the price points you're at right now? Did it take 3 aggressive candles or 1 long spike candle to get there? These are the things you have to ask yourself. Is this the end of the ride? Is it 3:30 or 9:30? Is it 12 o'clock in the afternoon when they go into consolidation? That's how you tell where you are in the cycle, by the timings and the behaviors, not by the technicals that regular traders look at. Market makers validate that stuff to trick you. Like I tell people, oh, they go out for about 3 days or so and they got to get some of their money back. They go, Steve, euro's been going up since its inception when it was 99 cents to the dollar. I remember that. I remember people saying that the euro will never pass the dollar, that it's a natural stop-loss barrier. And guess what? Those idiots didn't use a stop, and when it broke the dollar and never looked back, they're probably still holding open float from 01 or something. Understand, you have to start thinking from the back side of your screen. Start thinking like one of these guys. Start thinking, okay, what are the retail traders looking at? I see that consolidation accumulation phase right there. I know if I was on the other side of that, I'd be collecting up some contracts right now. What's my next move? I'm going to hit the stops 1 more time, snag everybody, and go the other way. That's how you have to start to think. When your mind opens up to that and start thinking like them, you will start to make money like they do. It's that simple. Okay. Once the peak is identified, the trend bias will be in line with the peak for 3 days minimum. Could it be 2.5 days? Yeah. If they come in at the London session for the peak formation, they can go London, US, London, change in US. Because the 3 levels were accomplished, but it was only 2.5 days. Very important. It is safe to trade V bottoms and V tops if you have clearly identified the cycle direction and the trap volume move. If you see the W anchor point to the low, and it goes up, goes into consolidation, the next day if they issue a V stop hunt like they did last night, it was actually a W, but it came right back out and repeated the level as a V right at the London Open. It's safe to trade that V because you knew it was part of a multi-session W, right? Here. Where did it go? All right, I don't know what happened to the folder. It got buried in this this stuff. I'll dig it up on the break and show you, okay? I'll draw it for you, actually, just right here on the chart. Let's do this. Okay, yesterday, we knew price was dropping. It made the spike, right? And then it went into consolidation overnight. Okay, when London came around, here's the London, Asian, right, market maker channel, Tokyo channel. When they made this out of the box and came back, this is technically a V bottom. But it's part of a larger structure that forms this W. So it's okay to take a V bottom when you, in fact, understand the directional bias by the market maker. Okay? Does that make sense? That's what I'm talking about. The big picture, the big thing. Don't get caught up, which most people do, and I understand that, but what I want you to do is get out of that idea, that concept. What most people do, I got to ditch the pen to get the slides back up. Okay. Is that you get jacked up in your little section of the chart, right? Okay, someone's saying the screen's black. I see my screen. Yeah, okay. Floyd, log in, log out, buddy. Okay, so here, look. Back to where I was, right? This is how it's usually going to play out. The W is going to form, and then it goes into consolidation. This is level 1, day 1. The next day, he might do this. That's okay to trade that. He's not always going to give you a perfect WWW every day. If he gives it to you, it's a bonus. Hey, Dave, I didn't see you, man. Nice to see you in here, buddy. If he gives it to you, it's a bonus. It makes it easier. Okay? That's what I'm talking about. I'm talking about that once the anchor point is set, then you, in fact, will understand the trend bias. Here we go. Anchor point, day 1, confirmed second leg reversal, right? The second leg, or the multi-session W, spread out, confirms that the trend reversal is on. Okay, what do you mean, Steve? If he comes back for a second swipe at those people, and it's spread out like over a day or 2 days, let's say he hits the low Sunday, and it comes back in here on Monday. If he spreads that out over 2 days, he ain't doing that because it feels good. He's doing that because there's a ton of cash down there. And the way to get it is to go down there and pick up those orders and like scrape money off the sidewalk. So what happens is you get day 1, level 1 rise, right? Goes into consolidation. You have your 1, 2. You might have your aggressive move away. You might have a 3-day rise within the day 1. All right, hold on. You're going to love this. All right, time to go. At the end of the day, he goes back into consolidation to end the day. He starts the cycle over, right? He then will make a V bottom. I was expecting this. If he does this, more power to you. It's better. But he may not always do that. So it's safe to make the entry off the railroad tracks because you're going to have your vector. 1, 2, 3 right out of the box. You might get a pivot laying there. Yesterday's tracer. Some things will be laying there. ADR low. Might be laying right there and give you an idea that, hey, the stop hunt should stall right here and the reversal's there. And then again, you have your 1, 2, 3. You may only get 2 levels in this example. Right? If he comes out again and issues a V, I expect this. That's good. Now the expected move is this and reverse. Back into the range. What's the range? High minus the low divided by 2. It's going to be right about here. If it's a 300 pip move, you can expect about 150 pip retracement. Okay? The V could hit the mayonnaise. It could hit the watermark. Okay? That's the cycle. And it's the opposite cycle for the way down. Okay, now, keep this drawing in mind. Okay? Now let's look at a chart. It's kind of funny. I drew it like that. All right? You have what we call a 33 trade on the last day. Okay? And I'm going to show you that. The 33 trade is a very aggressive day that guarantees a reversal of about 50 to 100 pips minimum. Here's why. Okay, isn't this pattern not only the intraday pattern, but it sets the beginning stage for the week? Right? Back into consolidation, vector 1, 2, 3 to the low. morning star formation around the mayonnaise can be construed as a V bottom or a W, depending on how you want to look at that. Right past the mayo. Why would he come down past the mayo and close aggressively past the mayo and then snatch it right back in one bar? Because it works. Hey, Wayne. It works because when they close below that, there's two candles below this, right?